Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the fact that the Federal Reserve, in their most recent FOMC minutes, has suggested that we will likely go into a mild recession later this year. We're going to discuss, are the indicators aligned with that potential outcome? If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So I'm not going to spend a ton of time dissecting everything in this report, but one of the things that I think should draw your attention is this sentence here. Given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year, with a recovery over the subsequent 2 years. All right. Now, this is a shift. It is not something that they've openly acknowledged before this. So it is interesting to see them talking about now they're projecting out a mild recession to in fact start later this year. The other thing that I wanted to mention about the minutes that were released before we get into the charts is the main risk that it seems like they saw was inflation staying high over potentially hiking too much and doing damage to the economy. So they still see the greater risk is inflation. So what I want to do now is go to the charts and see, does the data support a theoretical recession later this year? Now, the first thing I want to mention before we get too far into this, because we're actually going to go through quite a few charts here. So it's probably going to be a longer video. I don't really make any apologies for it. It's important to cover what we can, and I know there's a lot of sort of knee-jerk reaction type comments that might occur, and it could go something like, well, we were in a recession last year, and the other comment is we're already in a recession, right? So those are the two most frequent comments that I see. And those comments are not falling on deaf ears. I understand, the sort of the sentiment there, but I think that by the time we get through this video, it will be obvious, at least in my mind, it's obvious, but hopefully to a few other people, it'll be more so obvious why we haven't been in a recession over the last, year or so. And I know that looking at things like real GDP and whatnot would lead many to believe that. But by the end of this video, hopefully I've convinced you. Now, what we're going to start with is with GDP. All right, and we'll go straight to the thing that people will use to say that we already had a recession last year, or at least use that to claim that we're in a recession. If you look at real GDP and you look at say the quarterly change, the quarterly percentage change, you'll note that we had 2 consecutive quarters of negative GDP last year in 2022. However, if you were to use that to argue that we're in a recession now, that argument breaks down very quickly. And the reason for that is because we've been putting in new highs in real GDP despite the slump in early 2022. So even if you're in the camp that says we had a recession, we're in a recession because we had 2 consecutive quarters of negative GDP, that ended a long time ago, and we're still putting in new highs in real GDP. So usually, usually you're not putting in new highs in real GDP when you're in a recession. All right. Now, the other way to look at this, though, which I think is probably a bit more interesting, is to look at the yearly change. Look at the yearly change of real GDP. When you look at the yearly change, the yearly percentage change of the real gross domestic product, you get something that looks like this. Now, the gray shaded regions are recessions. Okay, and what you'll notice is that it has a pretty good track record of identifying recessions. There was even a time over here where it didn't even technically go negative, and we still had the dot-com recession, which was a pretty bad one. So, it was a pretty bad one in terms of the drawdown that the S&P had from the all-time high. But when you look at it this way, the year-over-year change, what you'll notice is that currently it's still positive. at least for Q4. I mean, again, it takes a long time to get these things updated just because it takes forever for the data to come in. But at least as of Q4 2022, this metric would not necessarily say that we've been in a recession. In fact, I mean, it still shows that we've had positive growth. Now, you might say, well, how can it be positive growth if this is coming down? Right? Well, remember, this is a change. When you see this coming down, as long as it's zero, or as long as it's above zero, you're still seeing growth. It just means that the growth is diminishing. It's like when you have inflation. Just because you have disinflation doesn't mean that the prices are coming down of goods and services. It just means they're not going up as quickly. So this metric here, the yearly change in real GDP, is going the growth is slowing down, but it's still technically growth. We have not entered into a truly contractionary period just yet. But with that said, we seemingly are heading in that direction. And so going back to the Fed minutes of projecting out a recession later this year, this metric would be in line with something like that. One of the things that I've said a number of times is that I think we'll have a recession in sort of the latter part of this year or early 2024 at the latest. Is my general assessment. And looking at these things again lead me to believe that that's going to be the case because we still see a lot of demand slowing. We are of course seeing inflation come back down, but that's also sort of on the back of just seeing lower levels of demand. Another one that we can look at is real GDP per capita. Now, if you look at real GDP per capita and look at the quarterly change, you'll see something very similar, right? 2 consecutive quarters of negative GDP. You go over to the yearly time frame, sort of the yearly change in real GDP per capita, and you'll see a very similar thing. Look how clean this chart is. Every time that it's gone negative, it has corresponded to a recession every single time. And you might say, well, is it negative right now? No, it's not. It doesn't mean that it's not going to turn negative, but currently we are still technically in an area of growth, even though that growth has fallen down quite a bit. So if you were to look at a percentage, you can see that the growth year over year is down to 0.431%, which has gone down a lot from, say, 5% just a year and a half ago or so. So this metric is trending in the recession direction, but it's not technically a recession just yet. So that's the point that I'm continuing to try to make, is that yes, there's indicators that suggest one's coming, but these indicators would also suggest that it's not here just yet. And if you look at the imports of goods and services, this is another metric that I think is interesting, and look at the yearly change on that, what you'll notice is that oftentimes when you see this go negative, it corresponds to a recession. Not always, though. So there's some metrics that have better hit rates than other ones. This metric does not always correspond to a recession if it goes negative. However, if it goes negative, it can at least correspond to, stunted growth for a while or stunted gains in the S&P 500. But oftentimes when you see it come down and go pretty deep in terms of the contractionary territory, it has not been a good thing for risk assets in general. And you can see right now that it's coming down pretty quickly. Furthermore, it seems to be accelerating the rate at which it's coming down, right? You can kind of see that this drop off here was from 22% to 15%, but the last one was a drop from 15% all the way down to 5%. So again, is it in contractionary territory right now? No. Is it heading that direction by the end of the year? Probably. You could also look at the exports of goods and services and look at the yearly change there as well, and you'll come to a pretty similar conclusion. I'm not going to spend a ton of time on each chart, but I will just simply pause here for a moment in case you just want to pause the screen and look at it and how it compares with the S&P 500 and prior recessions. And then you can also look at the net export of goods and services, look at the yearly change on that. And this one's, of course, the reverse, right? It's when it goes positive that is typically not a good thing. And you can see that it's already done that. Now that we've talked about, some of the growth statistics, I want to now go into actually some of the other interesting metrics. There's one that I was looking at earlier today, and it's the real gross private domestic investment. And if you look at the yearly change in that metric, you will see that historically, when you see it go into negative territory, contractionary territory, it corresponds to a recession. Not every time, as there's an example here in 2016. There's also an example here in 1951. But again, during those periods, it only went slightly negative. In terms of a percentage change, when you look at the percentage change of where we are right now, it's currently at negative 3.84%. So this is not going in the right direction. And this metric would suggest that we are getting pretty close to contractionary territory, recession territory. Again, a lot of these metrics say we're near it, or it's still, half a year or a year away, but a lot of them don't necessarily suggest we're there yet. This one suggests we could already be there. But you also have to take it in the context of every other metric, and most of the metrics say we're not in one right now. You can also go look at things like average hourly earnings and look at the yearly change on that. There's not a whole lot of data for this one, but normally, at least the last time we saw this come down quite a bit, it obviously wasn't really great for risk assets, at least initially. But then we sort of came out of it, and it slowly trended higher as the S&P continued to slowly trend higher. Right now, this is still just simply going down, right? I mean, we could clean it up a little bit by applying maybe a 3-month estimate to it, and you can see it's been a fairly steady decline here, but it's also fairly elevated as well. I mean, the area that we were at in 2009, this was already much lower down, right? We're pretty high up here in terms of percentage growth. So something to consider. If you look at real personal income and look at the yearly change in that, you will see recently that it's actually sort of crossed back above the zero line. It doesn't mean it can't roll back over. It did once before. So this metric is a little bit more optimistic. If you look at real personal income excluding transfer receipts and say look at a monthly change, this is what it looks like. But if you look at a yearly change, you'll see that it's when it goes negative that corresponds to recessionary periods. Is it negative right now? No, it is not. It is positive right now. So this is a metric that would suggest that we're not in a recession right now, right? So there's so many different indicators that we can look at, and of course, depending on what your bias is, you'll find evidence to support your what you want it to be. Here's another one. This is real disposable personal income yearly change. Let's switch this over to percentage. And again, normally it's when it starts to go down that it's not really a great thing. But I mean, sometimes it's not even captured at all. Right now, it's still going up. Right. I mean, it came down pretty quickly back over here just not too long ago, but since then it's actually been moving a little bit higher. This is another metric that would suggest that things aren't so bad at the moment. Doesn't mean they're not going to get worse later this year. Then we also have real GDP or real disposable income per capita. I'll put that chart there just in case you want to pause the video and take a closer look. Now, there are one of the more scary charts, I suppose, is the M2 money supply yearly change. Okay, this is something that is not a very common occurrence. And if you look at the history of this, when the money supply is dropping like this, it's historically been awful for risk assets in general. And the biggest counterpoint to that is to say, well, yeah, it would be bad, but we also just printed a lot of money in a relatively short period of time. So you could argue that we're more so just, say, regressing to the mean, right? Like if you were to think about this chart, you could sort of look at this chart and say we were on this sort of slope here, and now we're just sort of trying to come back down to that level. Now, if we go below the prior trend, which is certainly a risk, especially at the rate at which this is dropping, that's where it could become an issue. But again, like these things take a long time to play out. If you look at, the total assets held by the Federal Reserve, course, it recently popped up, but ever since then, it's been starting to come back down. This is obviously just QT. We've had it before. I mean, you can see we had it in 2019 as well. And when you get into periods like that, it does open up the door for potentially something to break. Right now, we're still slowly moving along. But this is something that if it continues to come down, of course, that will put pressure on the liquidity. We can go look at a few other things as well. There's the Treasury. Let's go look at the Treasury yield curve. Normally, this sort of formation here on the yield curve is an indicator that a recession is coming, not that we're in one right now. And this is what we talk about time and time again. You might hear someone say, well, the yield curve's inverted. That means we're in a recession. Actually, when the yield curve's inverted, it normally means we're not in one. It's upon the uninversion that actually would dictate when a recession could theoretically occur. Again, this is what it looks like right now. This is what it looked like in just before the financial crisis. This is what it looked like before the dot-com crash, right? So you can see that when it's inverted, it doesn't mean that we're in a recession then. It's upon the uninversion that actually occurs. And a better way to visualize that would be to look at Treasury yield spreads. But before I do that, there was an interesting development recently, and that's the fact that the 3-month Treasury yield has now gone above the 6-month. If you were to rewind the clock just a little bit, you can see that, I mean, even as recently as February, the 3-month was below the 6-month. Even March, right? Even March, the 3-month was below the 6-month. But now that we're in April, the 3-month is above the 6-month. And sooner rather than later, you'll likely see the short end of the curve raise above these as well, and more or less have a fully inverted yield curve, with maybe the exception of the the very long end over here. But again, something to consider. And a better way to visualize this is by looking at Treasury yield spreads. This is a spread on the 3-month and the 10-year. What do you notice when it's inverted like this? Usually, yes, there's this point here, but we don't really have a lot of data going before that. At least not on this. At least not on this chart. What you normally see, though, is when it's inverted, you're not in a recession. Again, the gray shaded region corresponds to the recession. When you're in the inverted part, you're not in one. It's when it becomes uninverted that the recession normally occurs. And right now, we're still trending in this direction, meaning it's becoming more and more inverted, which is kind of crazy to think about at what level it is right now, because we haven't seen this invert to this extent at least in 40 years, if not longer. So something to consider. You also have the 10-year and the 2-year spread as well, which has sort of come up a little bit recently, but it also did that, it also came up in the 1970s and still took a while before we actually got into a recession. But again, it's when it's like this, we're historically not in a recession. It's upon the uninversion that we would typically get one. So, there's a lot of indicators that would suggest that we're not in a recession right now, which is why I think it makes sense that the Fed's not saying we're in one right now. To say that we're in one right now would be to say that, the economy is doing very poorly, when on the contrary, the economy is still doing somewhat okay in terms of the unemployment rate, right? I mean, the unemployment rate is still pretty much at a secular low. There's a few other things we can look at. We can look at deposits in all commercial banks. We can look at the yearly change on that. Not really a great look. You look at the percentage change on this. Not really a great look here. It's not. I haven't really seen this before, so I don't really know what to make of it. You can look at deposits in small chartered commercial banks. You can see that it's also dropping off of a cliff right now when you look at the yearly change. If you look at consumer loans, the yearly change on consumer loans, it's starting to trend down, right? Which is not a good thing. Normally, when it starts to trend down, we run the risk of going into a recession. But it's only that trend has only recently started, as early as or as recently as maybe like October or so. So not really that, only about half a year ago or so. And sometimes, sometimes you'll see this come down, and it doesn't necessarily mean that the market cannot rally, right? There are times where it comes down where the market is still doing just fine. So this metric in and of itself is not going to be sufficient to tell you what's going on. If you look at consumer loans, credit cards, and revolving plans, we can look at a yearly change there. It's starting to roll over a little bit, but not too crazy of a move just yet. If you look at automobile loans and look at the yearly change there, let's switch this over to a percent. It is starting to come down quite a bit. But again, I mean, there's examples where it comes down, but it doesn't necessarily mean it has to immediately affect the stock market, right? If you say apply a moving average to, let's say, apply a 14-week SMA to the weekly change, this is what it looks like. And in this case, it seems like it's almost like once it starts to go up, you run some risk here in the market. Here's the consumer loans delinquency rate. It's starting to go up, which it makes sense because of all the tightening that's gone on. But even then, it's still at a relatively low level. I mean, it's only at 2%. I mean, we're just getting back to where we were, in 2016, 2017, 2018. We're still at pretty low levels here. If you look at business loans and the delinquency rate, it's still pretty low. If you look at here's an interesting one. The net percentage of banks tightening loan standards to large and middle market firms, it is getting pretty high, in line with prior recessions. If you look at the quarterly change on it, and maybe let's look at the yearly change. This is what it looks like, right? So it is at a pretty high level here, in line with prior recessions. And then if you look at the net percentage of banks tightening loan standards to small firms, this is what it looks like, pretty much in line with what we saw in prior recessions. This is what the yearly change looks like as well. I also want to take a look at smooth recessions probability indicator, which is a dynamic factor Markov switching model that uses non-farm payroll employment, the index of industrial production, real personal income excluding transfer payments, and real manufacturing and trade sales to develop a recession probability model. And as of right now, it says as of February, the probability of us being in a recession was only 0.74%. So that's less than 1% as of February. If you look at the SOM rule recession indicator, it says the current probability of us being in a recession as of March is 0%. This is because it's based on the unemployment rate, and the unemployment rate is still at a relatively low level. If you look at the RGDP recession indicator, you'll see that it's come back down, namely because the economy has picked back up recently. If you look at the composite leading indicator, it's heading in the wrong direction, especially if you look at, say, things like the monthly change. Normally, when it starts to sort of roll back over here, it's not, at least when you look at, say, like the yearly change or something, like this is not normally a good thing for risk assets when it's doing something like this, right? Like when it's coming this deep into sort of this regime. But it is starting to curl up a little bit here. So we'll see what ultimately transpires from that. If you look at the National Financial Conditions Index, we are starting to see financial conditions get a bit tighter. As you can see, over the last several weeks, they've sort of come up quite a bit. They are leveling off potentially a little bit here, but still, financial conditions have gotten a little bit tighter ever since the banking issues back in March. We also have the St. Louis Fed Financial Stress Index, which popped up fairly quickly a few weeks ago due to that meltdown in the banking sector, but it's actually come back down relatively quickly as well. And then, of course, some of the more important things are things like the unemployment rate, right? The unemployment rate is, it really shows us that we are pretty much at a secular low. Now, that doesn't mean that we can't see it go up, but at this point, I don't think you can look at an economy with an unemployment rate of 3.5% and say that it's in a recession, right? This is the biggest issue with the people that would say that we were in a recession in 2022 is, no one's going to look at this in the future and say that 2022 was a recession when you have, or at least most people won't, when you have the unemployment rate at secular lows for the business cycle. It would only be upon the sort of the rise in the unemployment rate that you could start to think about that. At least in my opinion. We also have people not in the labor force. We can look at the yearly change on that and see if there's anything interesting. I will let you pause the video and look at that if you want. We also have things like job quits. If you look at, say, the job quits level, you can see that it is trending down. Normally, when it trends down, it can lead you into a recession. And it's essentially been trending down for about a year now. If you look at the job quits rate, you'll see something very similar. And by the way, if you look at the job quits level, you can actually look at, say, total private and see that it's trending down. We can look at say, construction and see that it's more or less trending down with some spikes in there. You could look at manufacturing and see that it's trending down, but it's recently popped back up a little bit in recent months. We can look at durable goods and see that it started to trend down, but recently popped back up at the recent report. Non-durable goods, very similar types of stories, right? Initial claims has started to go up recently, which is something that is worthwhile to watch because initial claims typically can lead the unemployment rate. We also have continued claims, which is continuing to go higher. And normally when it goes higher, it can lead you into recession. It has been going higher for quite a number of months now. The counterpoint, though, is despite that it's been going higher, it's still at a pretty low level, right? This is almost just a reversion back to the mean at this point. So that's something to consider. If you look at the Michigan Consumer Sentiment Index, we were at a pretty low level over here, and it's actually starting to get a little bit better right now, and so on and so forth, right? I mean, we could talk about this all day. I'm sure we can go look at total vehicle sales if we want to see what that looks like. Maybe look at the yearly change there, and the monthly change, and just we can look at what it just what it looks like right now. I mean, it's not really giving a clear signal, right? It's just sort of very, very stochastic, right? Just sort of all over the place and not really giving anything specific. We can look at total industrial production, the total industrial production index, maybe look at the monthly change or maybe the yearly change there and see that it is trending down. But again, even though it's trending down, it's still technically in positive territory. So once it goes negative, though, we could find ourselves in a recession. So, I guess what I'm trying to say by looking at all these indicators is that does the Fed's outlook make sense within the context of the indicators that we have? I would say that it does. I would say that we were not in a recession in 2022 because the unemployment rate was still at a secular low, and it still is today. I would say that using only things like real GDP to talk about a recession is probably not the best approach. But there are a lot of metrics that would lead us to believe that a recession could come, later on this year. And that's something that we have to consider. And, if you're in the camp that says we won't ever, we're not going to have a recession, right? Like if you're in that camp, then that's a fun camp to be in. I mean, like there's always a chance that the Fed avoids it. I mean, there's always a chance they just decide to go print $5 trillion. And of course, the economy would pick back up and so would inflation. Then we just have to kick the can down the road a few more years. But if you're in that camp, we still have to deal with the inverted yield curve at some point, right? And normally when we come out of that, we have a recession, and we have to deal with the fact that the initial claims are going up, continued claims are going up. If we were to go take a look at the workbench just for a minute, and perhaps what we'll do is we'll add on some of these metrics, right? So let's add on recessions, okay? And then what I want to add on is initial claims. Okay, so we have initial claims. And then I want to add on continued claims. And then I want to add on the unemployment rate. Because the unemployment rate is really going to dictate, I think, when the recession actually starts. What you'll notice is that, continued claims and initial claims, they go up before the unemployment rate does, right? Like, so normally those are leading indicators. They tend to move before the unemployment rate moves. But still now, right, we're seeing these go up, but the unemployment rate really hasn't moved. So the point is like, just because it hasn't moved doesn't mean that it's not going to start moving within the next 6 months or so. So I continue to sort of think that we'll probably have a recession later this year or early next year at the latest. And I could see it lasting, it could last a few quarters, but I imagine that it probably won't be as deep of a recession as some people are calling for, right? Like I know there are calls for like depression level territory by looking at things like the money supply, but I think the counterpoint to that is that, well, The money supply is more so just reverting to the mean. It could overshoot it, which could lead us into that recession. But I don't think that, I don't think we're going to head into some like 10-year depression or something like that. That's my general take on the market in terms of, are we actually heading towards a recession or not? I think that we are not in one now. I think that there's a lot of indicators that suggest we could be heading to one by the end of this year, and I think we'll leave it at that. And I hopefully you enjoyed the video. I know we covered a lot of different metrics, and we will continue to follow them. But of course, I don't make these videos that frequently because we only get data for a lot of these charts like once a month. Some of them are weekly, but a lot of them are just like monthly or even quarterly. So it's not really that useful to provide that frequent of an update. But perhaps we'll do another update in a few months or so and kind of see where everything is. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and remember we do have Into the Cryptoverse Premium at intothecryptoverse.com. We have a sale going on. You can access this sort of stuff and look at a lot of these different indicators. Thank you guys for tuning in. I'll see you next time. Bye.